Okay, good evening and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the Chief Strategy Officer here at OptionPlay. And today we're here to talk about a strategy that a lot of people have been asking about in terms of how to deploy the wheel strategy. Now, we have actually covered the wheel strategy before, even if you have not seen me or heard me talk about it, because the wheel strategy actually consists of what I consider as the number one options income strategy. And simply that means that there's more people that trade this single strategy for options than any other strategy, which is a covered call. Many of you are familiar with that strategy, but combining that strategy with what I consider as the most underutilized option strategy by investors. From my perspective, if you sell cover calls, you should be selling cash secured puts. Cover calls are for stocks that you own, but in order to own those stocks, you need to first purchase them. And the question is, how do you purchase that stock? And that is really where a cash secured put comes in, where you can collect some income, and in many cases collect a fair amount of income in order to buy the stocks that you want to purchase. And that creates a discount mechanism to acquire the stock that you own in order to sell cover calls with. Now, when you combine these two strategies together, that's what we call the wheel strategy. So that's what we're going to break down today, really go through an example of a wheel strategy so you truly understand the difference between the two, or rather the combination of the two strategies, and see how it differs from just buying stocks and selling stocks using traditional limit orders. Okay, so before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we are going to discuss during today's session. So we'll start off by just helping you understand what is the wheel strategy and a quick review of a covered put and a covered call. We'll also take a look at some examples and take a look at, or actually one big example, if you will, of the difference between buying and selling stock using a traditional limit order versus using the wheel strategy. Then we'll talk a little bit about what are optimal covered puts and calls. What are the opportunity reports that OptionPlay publishes that helps you implement the strategy that we're going to discuss here today. And I want to share with you some of my trading tips for trading the wheel strategy. So before we jump into this, can everyone please bring up your chat window, which is at the bottom of your screen? And please type yes if you invest in any form of stocks in your portfolio. If you buy stocks in your portfolio and you sell stocks in your portfolio, please type yes into the chat window. And I would imagine that almost all of you that are viewing this session here today purchase stocks in your portfolio. And most of you probably use a limit order or perhaps a market order to purchase these stocks for your portfolio. And you probably use a limit order to sell these stocks once it reaches your target price or once it reaches a point where you no longer want to hold on to this particular stock. So how many of you now trade cover calls or cash secured puts? Type 1 into the chat window if you currently sell cover calls or cash secured puts in your portfolio. Okay, I see a couple of ones, but certainly far fewer ones than those of you that responded yes. Okay, so that means that there are many viewers here today that can use cover calls or cash secured puts, but for whatever reason, you're not using them in your portfolio today. So hopefully today, what I want to do is show you why you should use it and how you can maximize yield and participate in capital appreciation with your option strategy. So really, when you think about your equity position, it's a position that allows you to achieve capital appreciation. You're hoping to buy a stock at 100 crowns and sell it at 200 crowns and make the 100 crowns. That's capital appreciation. Now, if that stock pays dividends during the time that you hold on to that stock, that is income. But not every stock pays you a dividend, and certainly not every stock pays a large dividend. So what we are talking about is effectively extracting a dividend or an income from the equities that you own to offset, or rather augment the potential for capital appreciation that you have when you own the particular stock, and it offsets some of the risk that you're taking by owning that particular stock. So what is the wheel strategy? The wheel strategy is actually, like I said, somewhat simple. It's selling a put option to first acquire the stock. And what you're doing is you're effectively continuously selling puts until the put option gets assigned to you, at which you now purchase the stock. Once you purchase the stock, what you want to do is you want to now start selling cover calls. And you can continuously selling cover calls until that stock gets called away from you and you now sell the stock. And once you sell the stock, you acquire some more cash. And what you do with that cash is you further sell more puts. And when you do this in a circle, that's why we call it the wheel strategy. Okay, and it allows you to create a continuous income stream on the stocks that you wish to purchase and the stocks that you own. It allows you to purchase your stocks at a discount, and allows you to continue to participate in capital appreciation of the stock that you own while you create a continuous income stream on those stocks. And it's meant to just simply add income to your equities portfolio that you currently own in your portfolio that almost every single one of you have responded to yes. And the wheel strategy, like I said, is combined of a cover call and a cash secured put. If you're not familiar with what a cover call is, it's when you own at least 100 shares of an optionable stock or ETF and you sell a call option against it. Because if you just own the stock itself, your P&L would look something like this. As the stock went higher, you make more money. As the stock went lower, you lose more money. And there's no limit as to how much money you can potentially make. But however, what you can do is you can lower the break-even cost of your position by selling a call option. And when you sell a call option, what you're doing is you're capping the upside potential in exchange for some income that reduces your break-even price, reduces your cost basis on the stock that you own. And when you sell a call option, you effectively create the obligation to sell your stock at a higher price sometime in the future, which, if you think about that obligation, is the same obligation that you have when you place a limit order. If you own a stock at 100 crowns and you place a limit order to sell it at 110, you create the obligation to sell the stock at 110 if the stock rallies. Even if the stock rallies to 200 crowns, you are still obligated to sell your stock at 110. So when you sell a call option, you have the same obligation, but you're getting paid to do so. We're going to show you why getting paid to do so can be quite beneficial. Then we take a look at a cash covered put. This is similar to, if you look at the risk profile, very similar to owning the stock. But when you sell a cash secured put, you have to have cash ready to buy the stock or ETF. Similar to a limit order. When you place a limit order to buy a stock, let's say you have a stock that's currently trading at 100 crowns and you want to buy the stock at 90 crowns. Before you place that limit order to buy the stock at 90 crowns, you have to have the cash in your account to do so. So when you sell a cash secured put, same thing. You need to have the cash to acquire the stock. And when you sell a put option, it creates the obligation to acquire the stock at a specific price, but you are getting paid. So you collect a premium, you are getting paid to have that obligation. And that obligation either expires or it gets put to you. Regardless, you either have the opportunity to sell another put or you now own the stock at that specific price, just like a limit order. And I think it's really important to think about both obligations, a cover call and a cash secured put, as obligations that you would have if you were placing the limit order. But in both scenarios, you are getting additional income using a cash secured put and a cover call versus using a limit order. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you, because that's really the most important part of this, is that a lot of investors, when they learn about cover calls and cash secured puts, they might say to themselves, well, I don't want that obligation. Well, guess what? You already have that obligation when you place a limit order to buy your stocks and sell your stocks at a specific price. You may not think of it that way, but you absolutely do. And what you're doing today with the limit order is that you're not getting paid to have that obligation. What we're saying is that because you already have that obligation anyway, you might want to take a look at earning some income in order to have that obligation to buy your stock at a specific price and sell your stock at a specific price. So I'm going to use an example, ABC stock. It's currently trading at 50 crowns. If let's say I want to buy 100 shares of this particular stock at 50 crowns, and I think the stock is going to rally to 58 crowns, well, it's going to cost me 5,000 crowns to purchase 100 shares of the stock. My potential reward is 800 crowns if the stock does rally up to $58 and continues higher. So what I want to do is I want to compare this particular scenario for an equities trader or a stock trader, and I want to compare that with someone who's using the wheel strategy. And I want to show you the potential outcomes between the two. So let's say on day one, and this is what we're going to look at, is someone who's a equity only investor, and then we're going to look at someone who's using equities and options. Okay, so on day one, as an equity investor, what I'm going to do is I'm going to put in a limit order to buy 100 shares of this stock at 50 crowns. That's going to require me to have 5,000 crowns of cash available in order to place that limit order. And then as the options investor, I'm going to sell an ABC, which is the symbol, 50 crown put option. In this particular case, the May 6th put option for 3.15 crowns. So what happens is that when I sell a cash secured put, I require the same amount of cash as the person who's placing a limit order. But in this particular case, I'm collecting 305 crowns in credit, okay? On this particular day, when we're doing this, the stock is just trading at 50 crowns, okay? And let's say we fast forward or rather on day one, what happens is that I'm going to require to buy 50 crowns because the stock's trading at $50 or 50 crowns. I now own 100 shares of this particular stock at 50 crowns. And as an option seller, because when I look at this, I'm creating 315 crowns of credit. Here in this particular case, it requires me to have 5,000 crowns, but I'm collecting 315 crowns in income by selling the cash secured put. So what I want to do is I want to take a look at what happens if, let's say 30 days from now, the stock is currently trading at 51 crowns. Well, since I bought 100 shares of the stock at 50 crowns and now it's trading at 51, I now have a paper gain of 100 crowns, okay? Now, as an options investor, because I sold the 50 crown put option, if the stock is currently trading at 51, well, this option is going to expire worthless because my obligation is to buy the stock at $50 at expiration. If the stock's at 51, I no longer have the obligation to purchase the stock. Just like if you had a limit order at $50 and the stock's trading at 51, that order is not going to trigger. So what I have here is, instead of just an unfilled order, I have 315 crowns to show for my put option that I've sold that now has expired worthless. So as you can see, the two outcomes are quite different. Now, what I can do here as on the wheel strategy as an equity investor is I can sell another put option here and collect another 300 crowns. Here, I'm going to sell the 51 crowns put option for June 3rd. And let's say I collect 3 crowns again, and now I'm collecting 300 crowns for selling the put option. Now, remember, when the stock's trading at 51, I now own the stock at 50 crowns, and now it's trading at 51. So I have 100 crown paper gain. Here, what I've done is by selling the $51 crown option, I'm collecting a further 300 crowns on the particular on the current stock. And what I require now is 5,100 crowns of collateral because I sold the 51 crown put option. To buy 100 shares of the stock at 51 crowns, I need 5,100 crowns of collateral, or margin, as some of you would refer it to. Simply the cash that I need to put aside in order to purchase the stock itself. But as you can see, what's the difference between an equity investor and an options investor is that if the put option that I've sold expires worthless, I simply have the option of selling another put and collecting further income. So when we talk about a stream of income, it's really just as you wait to purchase the stocks that you want to purchase, you are able to extract yield. In this particular case, between the two options that I've sold, I've extracted 615 crowns of income already by selling the 50 crown put option that is expired and worthless, and now the 51 crown put option that we will see as to where the stock goes to determine what the outcome is. Now, let's say 30 days later, now the stock is back at 50 crowns. Now what happens is that my equity position is now flat. I own the stock at 50 crowns. It's now trading at 50 crowns. I have no gain. I have no loss. But as an options investor, because I have the obligation to purchase the stock at 51 crowns, if the stock is at 50 crowns at expiration, in this particular case it is, now I own this particular stock at 51 crowns. So I have to pay out the 5,100 crowns that I am obligated to purchase the stock with, and I now own this particular stock at 51 crowns. But I have 615 crowns of income to show for the amount of income that I've collected from the 2 puts that I have sold. So I now have a 100 crown paper loss on the stock because I bought the stock at 51, it's now trading at 50, but I have 615 crowns of income to show for it. So my net gain on this is still 515 crowns versus the equity investor at this point is still flat on their position because they have no income to show on this particular stock. They are simply taking on the fluctuations of the stock moving higher, moving lower, and effectively riding the stock. Here, what I'm doing is I'm also riding the stock, but I have income to show for this particular as an options investor. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. And the goal here, again, is to try to collect income continuously. And sometimes, the first put you sell, the stock gets put to you, and now you own the stock at that specific price. But many times you might find yourself selling multiple puts before the stock is put to you, or the stock is assigned to you. And during that time that you sell puts, that income is for you to keep. And that income will provide you with a discount and provide you with a discount to the stock purchase and income that you would collect on the cash that you're putting aside in order to acquire the stock, okay? So now in both scenarios, I own the stock. One, I own the stock at 51. One, I own the stock at 50. But remember, because I've collected 615 crowns in income, my break-even price on the option, now that I've owned the stock, is only 44.85 versus the stock investor has a break-even price of 50 crowns. That's where they purchased the stock originally, is at 50 crowns. But I am purchasing the stock at an effective rate of 44.85. And that's where I'm going to come out ahead, even if the stock declines, right? Even if the stock declines, I'm going to come out ahead because my break-even price is much lower than if I was just an equity investor. Now, once I acquire this stock, one of the things that you want to think about is how do I now generate income now that I own this particular stock? And that's really where I can sell a covered call. So now that I own this particular stock, what I can do is I can sell call options against it. So because I own this stock, what I want to do originally, my break-even price, my target price was 58 crowns. So as an options investor, what I would do is I would place a limit order at 58 crowns. And what I'm waiting for is for the stock to rally beyond that level. If it rallies beyond that level, I'm going to make the 800 crowns that I would make because I purchased the stock at 50, I sell it at 58. I'm going to make 800 crowns if the stock rallies up to 58. So as a stock investor, I would place that limit order at 58 and I would simply wait. This could take a day, a week, a month, a year. I don't know how long it's going to take. So as a limit order, I would place a limit order and I could walk away. If it happens tomorrow, if it happens next year, whenever it happens, I'll be able to take profit on my stock. That's the beauty of the limit order. It's really easy to do. As an options investor, what I can do is I can sell a cover call. In this particular case, let's say I sell a $55 crown cover call. Let's say I collect 2 crowns for this particular cover call. So what I'm doing when I have a cover call is I'm creating the obligation to sell the stock at that specific strike price. Just like how a limit order obligates me to sell at this specific price, a cover call obligation to the same obligations. But again, I'm getting paid to do so. When I place a limit order to buy and when I place a limit order to sell, there's no income attached to that. Every single time I sell a cash secured put, every single time I sell a cover call, there's income attached to this. So in this particular case, let's say I sell a 55 crown call option, I collect 2 crowns. That's going to add an additional 200 crowns of income to the 515 that I've already collected on this particular stock. So this is really where, as you can see, I'm really continuously decreasing the options break-even price. Every single time I bring in income, I'm lowering my break-even cost, so that even if the stock were to decline mildly, I have some level of protection. Versus as a stock investor, if the stock declines even mildly, I am going to start to see a loss. And the goal is to continuously move the break-even cost of your option down as low as possible, so that you have the largest possible downside protection for when the stock rallies. Not only do you reduce your risk, you're also adding to your potential reward. So let's fast forward now to the expiration of that call option. And let's say the stock is now trading at 52 crowns, right? So again, my stock position, I have a 200 crown paper gain. I bought the stock at 50, it's now trading at 52. I have 200 crowns of gains. But as you can see here on my cover call option, because the stock's trading at 52, the call option that I've sold at 55, that's going to expire worthless because the stock never reached the $55 level. So I keep the 200 crowns that I've purchased on this particular scenario, and now let's say I sell another cover call. Let's say I sell a $55 cover call expiring in July and collect another 2 crowns. So as you can see, I'm just going to continuously do this, and every time I do this, it's just going to bring down the break-even cost of my stock position from 50 crowns now down to almost 40 crowns. It's trading at a 40.85 crowns is my new break-even cost for my options position because of the premium that I've collected over the 2 short puts that I've sold and the 2 cover calls that I have sold. So now let's fast forward even further. Let's say the stock now makes a big jump next month, right? News comes out, earnings comes out, something happens and the stock jumps substantially higher. In both scenarios, you're going to see the stock is now called away. And as the equity investor, the stock is sold at 58 crowns. That's the limit order that I set for myself in terms of when I want to sell the stock. And when I sell a cover call, the strike price that I've sold the stock at is now going to be the obligation in this particular case. I have to sell the stock at 55 crowns. So what you can do here between the two is you can basically add up all of the credits that I've collected here and subtract the debits between the two. And what you see here is you have a combination of, I'm sorry, this should actually say 5,400 crowns versus a 915 crowns of credit, because I've made 400 crowns on the stock position. I bought the stock at 5,100 crowns. I've now sold it at 55. That's a total of 400 crowns. And then if you add up all of the premiums of the puts and calls that I've sold, I've collected 915 crowns here on these options. So the net gain that I have between the two is 1,400 crowns as an options investor and 800 crowns as the stock investor. So as you can see, the difference between the two is actually quite dramatic and quite different. And this is I would say, fairly mild example where you've sold 2 puts and 2 calls. Many times you're going to see yourself maybe selling 1 or 2 puts before your stock is acquired. But on the call side, many times you might find yourself selling 3, 4, 5 calls before the stock is actually called away. And you can actually continuously generate more income as you own the stock and hold on to the stock because of the income that you collect on the cover call side. Generally speaking, will be smaller per contract, but because you'll likely sell more contracts before the stock is acquired, you will find that the premiums may be somewhat comparable between what you collect on puts versus what you might collect uncovered calls. But the goal, again, is to further reduce the break-even point of the options investor to a point where you can have a very comfortable cushion from the stock that from the price that you've purchased the stock. And it gives you this downside protection so that even if the stock gets down to 40 crowns, and maybe at that point you might say, hey, I think I may have gotten the stock wrong. It may actually continue to move lower instead of moving higher, and maybe decide at that point that you're going to get out of the trade. And at that point, you're not taking a loss. You're flat on the position. Versus if you're just an equity investor and you get the directional view wrong, well, guess what? You're going to have to take a loss in order to get out of that position or get out of owning that stock. So the difference between these two are quite dramatic if you use the wheel strategy for the stock positions that you own. So before I move on, I just want to make sure everyone understands kind of the key differences between owning the stock as an equity investor versus owning the stock as an options investor. Can you please type 2 into the chat window if that makes sense to you as to the difference between these two? And I know that, it's not necessarily easy to grasp the first time, but just keep in mind the obligations that you create for yourself when you sell a put versus selling a call is the same obligation that you have when you place a limit order. That's the most important part for you to understand, because a lot of traders, when they're first starting this, they're concerned about the word obligation. They're concerned about, what do I have to do when I sell these options? Just remember, you already have on these obligations when you place a limit order. What you're doing here is you're adding an income stream to that obligation so that you can get paid income every single month that you're trying to buy a stock. Every single month that you own a stock, you can get paid income, and that income is going to reduce the cost basis of your stock. It's going to give you that downside buffer, and it's going to give you a little bit of breathing room so that if the stock doesn't move in the direction that you expect it to, you don't have losses as quickly as if you were just an equity investor, okay? So that's the wheel strategy in a nutshell. And I want to do a thought experiment here. I want to ask the audience here a question, because I've used an example of a stock trading at 50 crowns, but I want to use a real example to show you how to pick where to sell your cover calls and where to pick your cash secured puts. So I'm going to use Ericsson B. And in this particular case, this is an older example, but the stock at the time was trading at about 103 crowns. Now, let's say you look at the options chain, right? We're looking at an option that expires in roughly 45 days. Let's say you're looking at the option chain and you see that there's lots of options that you can sell. You see that there's a 107 and a half that collects 2.5 crowns. You see a 110 that collects 1.5 crowns. And then you see a 112 and a half that collects 1 crown in income. Remember, this is a covered call, okay? You've already owned the stock. And the strike price that you select tells you where you have to sell the stock. So when you sell the 107 and a half, that's your obligation. If the stock reaches 107 and a half, you have to sell your stock. The 110, it means the stock can go a little further before you have that obligation. And the 112 and a half means that you have the furthest move before the stock is called away. And you can see how much premium that you collect for each one. You collect 1 crown for the 112s, 1.5 crowns for the 110s, and 2.5 for the 107 and a half. And these are the corresponding returns, the static return and the annualized return of each one of these strategies. So I want to ask you, if you had to pick a strike price to sell on Ericsson B, which is the stock that you own, which strike price would you choose? Type your answer into the chat window. Which one of these 3 strike prices would you choose? The 107 and a half, the 110, or the 112 and a half? Type your answers into the chat window. Okay. The answers typically, I see 107 and a half, 107 and a half, 110, 107 and a half. So the predominant answer here is 107 and a half. The one that collects 2.5 crowns. One person did end up saying the 110s that collects 1.5 crowns. Well, this is really where we have done the research. We have back tested this strategy across almost every single possible expiration date and strike price from 2007 to today. Because we wanted to know when we're looking at that options chain and you see all of those choices, which one should you choose? And our research is very clear as to the fact that the best strategy to choose is actually the 112.5 crowns. And you might ask yourself, why would anyone choose an income generating strategy that collects 1 crown when you can choose an income generating strategy that collects more than double that, 2.5 crowns? I want to have as much income as possible because you just showed me that if I bring in a lot of income, I'm going to reduce my downside cost basis, and that's going to give me a better outcome in the long run. But that is true that you want to maximize income, but keep in mind, you have to think about what you are giving up for that income. So think about it. What happens if next month something happens and the stock rallies substantially? The stock rallies up to 120. This is really why you want to think about being more conservative when you're selling cover calls. Because yes, you collect an additional 1.5 crowns when you sell the 107.5, and an extra 1.5 crowns is certainly going to sound good, right? But what are you giving up for that? Think about it. If the stock rallies, this is the price that you have to sell your stock at. What you're saying is that I'd rather take 1.5 crowns up front, and I'm going to give up 5 crowns on the back end of that, right? Because if the stock rallies substantially, if it goes to 120, you sold your stock at 107.5. Versus if you sold the 112s, you would sell the 112.5. So what you have is an additional 5 crowns in upside by giving up that 1.5 crowns of income. And what we see here is that over and over again, especially over a long run, as you sell many, many cover calls, you're going to have some scenarios where the stock rallies significantly. And what you want to do is you want to make sure that you're able to capture that, because that's actually your biggest opportunity to make profits with this strategy. It's not the income that you collect that's where the most premium or where you're going to collect the most money or the most profits. The most of your profits are actually going to come from when the stock rallies substantially. So that's why when you're choosing a strike price, it's better to choose strike prices that are further away, that collects less income, because you never know what's going to happen the next month. And what you want to make sure is that because you don't know what can happen, when the stock does rally substantially, you want to make sure you're able to capture that. And that is the most important part. You don't want to give up 5 crowns for 1.5 crowns of income today. Does that make sense? Please type 3 into the chat window if that makes sense to you as to why you want to choose that 112.5 strike price and not the 107.5 strike price, which again, when you're looking at this from the first time, I completely understand why you want to choose something with a higher raw return and annualized return, but that many times is deceiving because what you're giving up is far more than what you apparently are receiving in additional income, okay? Now, let's take a look at a short put. I'm going to use Dom here, trading at the time at around 146 crowns. I'm going to do the same thought experiment. I have 3 strike prices, right? So now we're purchasing the stock, right? Think about where you place a limit order. So if you sold the 145, which is basically the at the money put option, it collects 5.5 crowns. If I sold the 140, collects 4 crowns. If I sold the 135s, collect 2.5 crowns. And these are your corresponding return values here on the right-hand side. So same thought experiment. Which strike price would you choose? The 145, the 140, or the 135? Type your answer into the chat window. Which one of those 3 would you choose? And now I see a bunch of people saying 135. Basically, I think taking what you've just learned from the previous slide and now selecting strike prices that are furthest away from the stock that from the current stock price. And I wouldn't blame you for it. I do have one person saying they choose the 145s. Well, this is also where we've done a lot of back testing and testing. And what we find here is that when you're selling a cash secured put to acquire the stocks that you want to own, the better strike price is actually the strike price that is closest to the current price of the stock. And you might be confused as to why. I just taught you on cover calls that you want to choose strike prices further away. But remember, you already own the stock in that particular example. When you're selling a cash secured put, your goal is to own the stock. So think about a limit order that you're placing to purchase the stock that's currently trading at 146. If you place a limit order at 145, you're going to have a pretty good chance of owning that particular stock. If you place your limit order at 140, your chances of owning that stock is simply going to be lower. And if you place your limit order at 135, your chances of owning that stock is even slimmer, because what are the chances the stock is going to pull back this far before it rallies? The further away that you place your limit order or your short put, the less chance that you'll end up owning that particular stock. So when you're thinking about purchasing a stock, what you want to do is you want to think about increasing the probability of owning the stock and increasing the discount that you purchase the stock with. And you're going to get that with strike prices that are close to the current price of the particular stock, because I'm going to collect 5.5 crowns of income by selling the 145s, and I have the highest probability of owning this stock. And those are the two things that you want to prioritize when you sell a cash secured put. So when you're selling a cash secured put, choose strike prices that are close to the current price of the stock. And then when you're selling cover calls, choose strike prices that are further away from the current price of the stock. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you, because this is one of the most important practical elements of this strategy. Up until now, we've been learning theory, we've been learning concept. This application of it, selecting specific strike prices and expiration dates, this is the practical side of things. So when you go into your portfolio and you think about the next stock that you want to purchase or the next stock that you want to sell cover calls on, you have to select a strike price, and you want to make sure that you have the right frame of mind in selecting your strike prices with cover calls and cash secured puts. So at this point, what I do is I want to jump over to the cover call and cash secured put reports that are available to you here at OptionPlay. And what I'll do is I will send you the link here to access both reports. We publish a daily cover call and cash secured put report. And we do this because we want you to understand from when you're using this particular strategy, how you can go about finding opportunities in this market. And we will actually tell you the exact expiration date and strike price and the amount of income that you're collecting by selling those cover calls and cash secured puts. Let's take a look at P-Cell here. I want to take a look at P-Cell, and you can click on any of the symbols here on the right-hand side. As you can see, there's a trade link button here on the right-hand side. When you click on it, it will actually open the trade up in OptionPlay so that you can view this particular trade in OptionPlay and analyze it before you execute each of these trades. And you can access OptionPlay either through app-nordic.optionsplay.com, or you can click on one of these reports and click on one of the links. It will open up OptionPlay with the specific symbol and the specific option strategy that you've selected in the tool itself. So I, in this particular case, looked at P-Cell here. Let's say this was a stock that I wanted to purchase. The stock is currently trading at around 139 crowns. This is telling me to sell the July 120s. And what this will do is it will show me that if I sold the July 120s, I will collect 1,000 crowns in income. Now that is a lot of income in this particular case for this particular stock. This is a stock that has sold off quite heavily here. As you can see, recently reached prior support here around 120 or so. So maybe you want to purchase this stock near the bottom here, near that support level, and this is an opportunity for you to do so. You can always modify this and you can change the premiums if you want. You can change it to maybe, this was the 120s we were looking at. You can change the premiums from the 120s to maybe the 122.5 to 125s. You can do this and you can see how much premium that you need to collect on this. How much premium you would collect with each one of these strike prices. And this is something that, we're looking at a cover call. Sorry, I want to look at a cash secured put. So here, as you can see, if I sell the July 120s, I'm going to collect 1,050 crowns, and I'm going to need roughly 11,000 crowns in order to purchase 100 shares of this particular stock. Now, I'm getting effectively 1,000 crown discount on the stock purchase if I sold this put option, versus if I just simply place a limit order at this prior bottom here at 120, I would have to wait for the stock to reach this particular level. And maybe the stock never reaches that level. Maybe the stock just starts to take off, right? As an equity investor, you don't participate in that capital appreciation. Here, you don't participate in that capital appreciation either, but at least you have 1,000 crowns of profit to show for it if the stock just rallies back into the 200 range, right? That's the difference between a limit order and selling a cash secured put, is that if you don't end up owning the stock, as a limit order, you have nothing to show for it. With an options investor, many times you have quite a bit to show for it. Here, you have 7% of the underlying stock's value that's paid to you between now and July 15th if you sold this cash secured put and the stock never trades down to 120 by the expiration date. You have 1,000 crowns of profit to show for that. That's 7% in 2 months. That's a fair amount of yield. That's a fair amount of capital appreciation. Even if you did own that stock, the stock went up by 7% in 2 months. You would probably not be you wouldn't be unhappy if the stock that you bought is up 7% in 2.5 months. From an average perspective, average return perspective, that is quite high. I mean, this is a quite high premium to collect from the cover calls, from the cash secured put side, but what this report provides for you is opportunities to generate income. And what you can do is you can simply go down the stock and look for stocks that you want to purchase. Maybe you're looking at KinVB and you're saying, this is a stock that I like. I would be interested in purchasing this stock. You simply click on the link and it will bring up OptionPlay and it will help you analyze the strategy, see how much premium you're actually collecting, and that will help you better understand as to whether or not this is a strategy that you want to deploy. And I just sent everyone the link to access these reports, both the cover call and the cash secured put report. So for KinVB, as you can see, if I sold the July 175 puts, I'm going to collect 1,530 crowns. This stock did decline quite a bit here today, so maybe I might want to modify this and maybe look at selling a slightly different put option here. This was the July 155s. Oh, I see. Right now, it looks like there's limited strikes here for this particular stock. So we're going to come back to this and we'll take a look at what other options are available here for this particular stock. But we will find one where maybe, let's say, SBB here that's trading at 28 crowns, and maybe we want to take a look at the 26 put options that we can sell on owning SBB. And this will give you a better understanding as to which one of these strategies is perhaps best suited for you. Let's see. Here, the stock's trading at 27.30. It's now selling the $26 put. That's going to collect 200 crowns while requiring you to put up 2,400 crowns to sell this cash secured put. So think about that for a second here. You're collecting 200 crowns while putting up 2,400 crowns of, that's almost 10% of the underlying stock's value. It's actually 7.33% of the underlying stock's value that you're collecting over the next 58 days, right? Now, that's going to provide you with a 7.5% discount, a 7.5% downside protection. If you do own this particular stock at that $26 level, you're going to, instead of owning at 26, you're going to own it at an effective cost basis of only $24. So you're getting a 2 crown discount and a 2 crown downside protection if you do own the stock. If you don't own the stock, you just have 200 crowns of profit to show for it, okay? And our report makes it very easy for you to find these opportunities. You simply go down the list and find stocks that you want to purchase. Maybe H&M is a stock that you want to purchase. Whatever stock you want to purchase, you simply look for it, click on the symbol or the link on the right-hand side, and our platform will help you find the the exact expiration date and strike price and help you analyze how much premium there is in that. And we have the same thing for a cover call report. The cover call report does the same thing. It's for stocks that you own in your portfolio. And what it does is it tells you how much premium you can collect if you sold a specific cover call, and it finds the cover call for you. So let's say we're looking at, let's take a look at Husqvarna. Let's say you own Husqvarna as a stock. And what you can do is you can click on the symbol here on the right-hand side. And what that does is it's going to help you understand, if you own this particular stock, how much premium can you collect by selling cover calls on this particular stock. And it's going to allow you to understand the yield that you're collecting. So for example, if I own Husqvarna and I sold the $95 cover calls and the stock rallies up, I'm going to be able to collect, in this particular case, Husqvarna, I was collecting 325 crowns on this particular stock. So 325 crowns comes out to be roughly 3% of the stock's value that I collect in 58 days. And what's interesting about Husqvarna is that Husqvarna actually pays a nice dividend. It pays 2.86% per year. So if you own this stock, you're going to collect 2.86% of the stock's value every single year you hold on to this stock. But if you look at the cover call, I'm collecting virtually the same amount, 2.95%, right? I'm collecting virtually the same amount as I collect in the dividend on this cover call. But instead of doing it over 1 year, I'm doing it over 58 days. What that means is that I can do this roughly 6 times in total of cover calls and collect roughly 6 times the income that I would collect on the dividend from cover calls. That just shows you how big of a difference the income from a cover call is versus the income from a dividend yield. As you can see, in this particular case, it's about 6 times higher from selling cover call income than you do on the income that you get from an underlying stock. And that's how big of a difference that you can ultimately will see when we look at that wheel strategy, right? And I show you the difference between owning the, selling cover calls and cash secured puts versus buying the stock. We're usually looking at income levels that are 3, 4, 5, sometimes 10 times greater than the dividend yield on the stock versus the dividend yield on a stock itself from the cover call and the cash secured put. So that just hopefully gives you some sense of not only the strategy, the practical elements as to how to go about doing so, but also a sense for how big of a difference that you might expect as an equity investor versus an options investor. So with that, that covers what I wanted to share with you here today. I do want to leave you with a couple of tips to help you better implement the strategy before we open this up for Q&A. My number one tip for using this particular strategy is to only focus on stocks that you're familiar with and stocks that you're comfortable investing in. Do not sell cash secured puts on stocks that you don't know about, but that you're not familiar with, because ultimately you are making an investment in that company by selling a cash secured put, because you're obligating yourself to buy at least 100 shares of that company. You shouldn't buy stocks in companies that you don't understand or that you don't feel comfortable investing in. That's first and foremost. Second, if you're looking for high yielding income, sort the report based on the raw return. That's what the report is sorted by default. So that's really where you want to look for stocks at the top of the list. The further up on the list, the higher the yield of that cover call and that cash secured put. So if you're looking for income, you're looking for high yield, look at the top of the list. And as far as, if you're working with a smaller portfolio, what you can do is you can sort the list based on the stock price and simply focus on selling cash secured puts and stocks on stocks that are lower priced. Some of these are as little as 200, 2,300, 2,500, 5,000 crowns to sell 100 shares of the particular stock. And lastly, when you're thinking about earnings, generally speaking, this is a strategy that you can trade during earnings. But for those of you that are relatively new to this strategy, you might want to avoid selling going into an earnings. So it's important to look at the earnings date and make sure that there are no earnings between now and the expiration date of the option. If there's an expiration, if there's an earnings and the earnings is near the expiration date, you're okay, you can still do so. But if, let's say, your earnings is coming up just a few days after you sell the option, those are the ones that you generally want to avoid. Okay, so those are some of my tips that I have for selling, the wheel strategy or implementing the wheel strategy for your portfolio. And for those of you that do not have access to the tools that I've shown you here today, the OptionPlay platform or the cover call or cash secured put report, you can sign up completely free of charge at optionsplay.se. This is a partnership that we have with NASDAQ Nordic. They are effectively supplementing your costs for access to the platform, access to education like we are hosting today, and access to the reports that help you implement this type of strategy for your portfolio. So this is, again, all available to you at optionsplay.se. So please make sure that you take the time and register for these things, access the reports. I just sent you the link to access these reports in the chat window. I will send it again right now for those of you that do not have access to this so that you can implement these strategies in your own portfolio. So with that, what I'll do is I'll open this up for Q&A, and I will open this up for Q&A, and I will stay here for as long as I can to try to answer as many questions as possible. So type your questions in the Q&A window, and I'll try to answer your questions there. Any questions? John, yes, this is recorded. So you will be able to receive both the slides and the recording after today's session so that you can watch the recording and follow along with the slides at your own pace. If there are no questions, I just want to thank everyone for taking their time out here this evening. I really hope that this was helpful in giving you a better understanding as to how to utilize this particular strategy, because I really think that this is by far the most useful option strategy for everyone who's watching. It doesn't matter whether you're an experienced or a new options investor. If you have experience trading stocks, that's really all you need to know in order to implement this strategy, because the option strategies that we're discussing here today do not add additional risk to your portfolio compared to buying the stocks using a limit order. They're actually all reducing the amount of risk, because if you sell a cash secured put, your break-even price is always lower than if you place a limit order. So you're going to have lower risk by selling a cash secured put versus placing a limit order. Same thing for a covered call. A covered call is not going to add additional risk to your portfolio. So it's actually going to reduce risk in your portfolio. So this is all about reducing risk, reducing your cost basis, and hopefully implementing an income stream for your portfolio. Lars is asking, can I buy a put to avoid a cover call to expire? I'm not sure what you mean by can you buy a put to avoid a cover call to expire? If you don't mind clarifying, you can certainly buy a put. That's not going to avoid a cover call to expire. I mean, calls expire regardless of, that's just a time-based thing, right? Nothing that you do will stop a call from being expired. All options expire on their expiration date. If you're referring to having it assigned, then you can buy back the call that you've sold to avoid the assignment. So let's say the stock is trading above your strike price and it's approaching expiration date and you want to keep the stock, meaning you don't want the stock to get called away. Then what you can do is you can buy back the call option that you've sold. And as long as you buy back the call option that you've sold, that's going to remove the obligation to sell the stock, and you can effectively continue to hold on to that stock. You must do it before expiration. You cannot do it after expiration. You must buy back the call option prior to expiration. Okay, if there are no other questions, I just want to thank everyone for taking the time out here this afternoon. And I will be back here next month to do our next event. I hope to see you guys there. Again, if you have any thoughts or if you have any strategies that you want to learn more about, feel free to send us an email at info@optionsplay.com. Would love to hear from you. You can always type in your comments into the YouTube videos of the recordings that we send out as well. We read those comments. It'll help us better understand what you guys want to learn on the next session. So thank you so much. Have a great evening, and I'll see you guys here next month on our next options education session. Have a great evening.